Welcome back everybody, and in this small lecture we'll discuss about section 33AB and section 33ABA. Two sections will be covering, small sections, a small video for this. Okay, so first topic is tea, coffee, rubber development account. So what is the topic's name? Tea, coffee, rubber development account. Section 33AB. So what this section says? This section is actually applicable not to all the different types of business. It is applicable only to specific businesses which are engaged in growing tea, right? They should be engaged in growing and manufacturing of tea. Like if you talk about Tata Tea, what they do in Assam and in many places across the globe, I can say, they have tea plantations where lot of plants are there. From that they actually take the tea powder, right, and ultimately supply to the people. So from agricultural activity to manufacturing activity, both are handled by Tatas. So for these type of businesses, this section is applicable, whether it is tea, whether it is coffee, whether it is rubber development account under section 33AB. Now, to apply this section, to get the benefit of this section, because I already said from section 30 to 37, it is all deductions, deductions, deductions. That means this is also a benefit. A deduction only you are going to get. So for claiming the deduction, 4 conditions are to be satisfied. What are that 4 conditions? First condition is the assessee. It may be individual, it may be company, it may be partnership, doesn't matter. Any person is okay. But the assessee must be engaged in tea, coffee, rubber plantation. Then if they are engaged in tea, coffee, rubber plantation, it's not enough. They have to deposit the money also. Where? Under NABARD, National Bank for Agricultural and Rural Development, or any other specified bank mentioned by the respective boards. So either deposit the money in NABARD or any other specified bank approved by this board. Okay, if you satisfy these 2 conditions, then we will see the third condition. Now, I said you should be engaged in this business. You should deposit the money. But when you should deposit the money? Within 6 months from the end of the previous year. When you should deposit the money, tell me again. Within 6 months from the end of the previous year. It may come in the MCQs. Okay, so please remember, within 6 months from the end of the previous year. And second part, that is before filing returns. So condition number 3 says you should deposit the money into NABARD or specified bank within 6 months from the end of previous year or before filing returns, whichever is earlier. Whichever is earlier. And fourth condition says that you should get your books of accounts audited through a chartered accountant and submit the form 3AC to the income tax department. Okay, because everything is digital now. Incometax.gov.in is the website through which you will upload 3AC form. If you do this, that's it. But suppose example, your books of accounts are already audited under Companies Act 2013 or maybe under some other law. Then is duplication of work required? The law says not required. If already some audit is done under some other law, let that audit be done. Same audit report along with form 3AC should be submitted by the chartered accountant. That would do. So I said 4 conditions to claim deduction under section 33AB. What are that 4 conditions? You must be engaged in tea, coffee, rubber development account or plantations actually. Okay. Deposit the money in NABARD or any other specified bank within 6 months or before filing returns, whichever is earlier. And a report from a chartered accountant under form 3AC must be submitted to the income tax department. right? If audit you have to do under this section, or if it is done under any other law, that audit report is also fine. Then how much deduction we get? The amount deposited. So we were talking about the amount should be deposited, correct? So you will get the deduction of amount deposited, or 40% of the profit. Huge amount, correct? 40% of the profit before claiming this deduction under 33AB. Okay, and before set off of losses. So you will get the deduction of whatever amount you deposited with the board or with the bank, right? Or 40% of profit before 40% of the profit before this deduction, that is 33AB, or before set off of any losses. So you will have incomes minus expenditures. Then you will get profit. But while deducting the expenditures, don't deduct 33AB reduction. Don't deduct any set off and carry forward related losses. Without these two, all expenditures which are mentioned under 30 to 37 you deduct. And then you will get some business income before these two items. Okay, that profit into 40% or amount deposited, whichever is lower, will be allowed as deduction. Great. But sir, if you deposit the amount, that amount is lost? The answer is no, it is not lost. That amount deposited is your money only. Don't worry. Okay? You can purchase eligible asset from that money. Right? So, if you withdraw the money, how the treatment should be? So, there are three categories discussed here. See, you deposit the money, you get the deduction. So, you save taxes in the year in which you deposit the money. But the year in which you withdraw the money, they ask three things. Is it for purchase of an eligible asset? Is the withdrawal for purchasing a non-eligible capital asset? Or is it for some other reason? Now, if it is for purchase of an eligible asset, maybe some plant and machinery, correct? In that case, whatever amount withdrawn will not be taxable. Whatever amount withdrawn will not be taxable. Let me tell you again. For the purchase of eligible asset. What does this mean? Dekho, for the purchase of eligible asset, if you purchase like plant and machinery you purchase, then definitely whatever amount you withdrawn will not be taxed. And please remember that eligible asset should be maintained for how many years? Up to 8 years you should not sell it. You should not transfer. Then your withdrawal is not taxable. But suppose you withdrawn, suppose 3 crore rupees for purchase of eligible asset. You use 2.5 crores to purchase the eligible asset. And balance 50 lakhs, you kept it like that in cash. So that 50 lakhs become taxable. That 50 lakhs become taxable. Okay. Now, so unutilized amount is taxable. Right? Because it is agriculture part, so there is some ratio which we discussed in agriculture chapter. You remember for tea, agricultural is 60% and business portion is 40%. So if this cash is also unutilized, only 40%, that is business portion, becomes taxable. Okay? Right. Now let me continue with the story. So if you purchased an eligible asset, right, and some cash is unutilized, then whatever unutilized cash into business percentage, which we discussed in agriculture chapter, that will be taxable. Okay. And for purchase of plant and machinery, whatever utilized, that is not taxable, provided you keep that asset for 8 years. But suppose you sell the asset within 8 years, then what will happen? there are two things. One, whatever deduction you got earlier, that becomes deemed income under section 41 and becomes taxable. What I said, whatever deduction you got earlier becomes deemed income and becomes taxable. Okay, that's done. First part is clear. Now come to second part. The second part of the story is it is deemed income, right? And taxable, I said. What is deemed income? The deduction what you got earlier. Now practically in our exams, if such question asked, you will not be able to see how many years deductions are there. So you will simply say whatever amount withdrawn, right? That withdrawal amount becomes deemed income under section 41. Okay. Sometimes what happens, law says something, but to understand it, we have to apply our logic. Okay. Right. So what we discussed, if you purchased an eligible asset, right? And you withdrawn some money for that. You withdrawn some money, but some part of the amount you did not use it for purchase. That part is taxable. Only business portion is taxable. Agricultural portion not taxable. Right? Whatever used for purchase of eligible asset, if the asset is kept for 8 years, then no problem at all. Or if you sold the asset within 8 years to government like state government, central government, local authority, or under succession of business, right? Your company was there, you transferred the company to new company, your father's business was there, he transferred it to you. So if it is a case of succession, if it is a case of amalgamation, if it is a case of transfer to government, local authority within 8 years, then not at all taxable. Right? Even you broke the condition of 8 years, they will consider that you did not break the condition, no problem. But if you transfer the capital asset other than to these cases, like other than succession, amalgamation, transfer to government, local authority, other than these cases, if you transfer the asset, the withdrawal which you did for purchase of this asset will become taxable under section 41. And obviously, because you sold the capital asset, on that your capital gain income will also arise. This you should understand. Of course, I did not write capital gain income concept here in these notes, but because it's a capital asset, because it is transferred, capital asset will arise, and we'll discuss that in capital gains chapter in detail. Okay. Now we completed eligible asset. So eligible asset clear to all of you. Let me repeat again. Not required. Very good. Now let's go to ineligible asset concept. Suppose if it is an ineligible asset, then whatever you withdraw, that becomes taxable. Simple. In simple language, ineligible asset means you purchased office equipment, residential equipment, guest house related assets, right? Office equipment, residential equipment, guest house related assets, or office equipment, guest house equipment, residential house related assets, or any other plant other than office computers you purchased, which is to be used in office. Like obviously ACs are there. ACs are not computers, correct? Inverters are there. Like that they are telling. Second point. Okay. Third point, any asset on which 100% of the deduction is claimed. Like any plant and machinery you purchase for scientific research, right? Or any plant and machinery you purchased under section 35 AD. Under 35 AD, whatever list of businesses are given, for that any capital expenditure, 100% deduction. Under 35 subsection 1 clause 4, any capital asset purchased for scientific research, 100% deduction is given. Now, if 100% deduction is already given for that capital asset there, under 35 subsection 1 clause 4, under 35AD, then there is no need to give deduction under 33AB, right? That's why scientific research assets become ineligible assets. Concept is clear. No double deduction, right? Here also you get deduction, there also you'll get deduction. It should not be done. So you get deduction there, here you become ineligible. Okay, like this you should remember. And 11th schedule related assets. Array, if you are actually manufacturing something like plastic bottles, right? Some miscellaneous type of industries are covered in 11th schedule, right? Some chiller we can say, right? So such type of things are covered in 11th schedule. So if you purchase the assets or plant and machinery for 11th schedule items also, you will not get deduction. So what are ineligible assets? Come on, let's try to remember. If it is a office, residential or guest house equipment, right? Any plant in the office but not computers, like AC, inverter, I said. Assets on which 100% deduction you claimed. Like I gave the example of 35 subsection 1 clause 4 35AD. These two sections. Scientific research related, specified business related. And 11th schedule items, we already know that it is something very basic type of plant and machinery for producing very basic things. So for this, you will not get deduction under section 33AB. Now, some other reasons may also be there why you may withdraw the money. It may be like whatever taxable I group one, and whatever is not taxable I'll keep it in one group. Okay. Suppose if it is partition of HUF, Hindu undivided family, liquidation of a company, or death of an associate. What I said, partition of HUF, liquidation of company, death of an associate. Partition of HUF, liquidation of company, and death of associate. If these three conditions are satisfied, if any of the three cases may be there, then it is not taxable at all. So whatever you actually withdrawn for these three reasons, it is not taxable. But if it is a case of closure of business, if it is a case of dissolution of partnership firm, I said two cases, closure of business, dissolution of partnership firm. In these two cases, government is shrewd. Government says it is fully taxable. So if you withdraw the money because partnership dissolved, because business is closed down, then entire withdrawal is fully taxable. This way you should be able to understand. Let me continue with the further points. What is the next thing? Calculation of income. Now in case of tea, you know, right? 60% is agricultural income, 40% is treated as business income, correct? So in case of tea, you will simply say 40% of the revenue minus 33AB deduction. Similarly for rubber, 65% is agricultural and 35% is business. So 35% of your income minus 33AB deduction. That becomes taxable income. But in case of coffee, there are two different points. If it is coffee grown and cured, then 75% is business, agricultural, 75% is agricultural and 25% is business. Yes or no? Are you able to recollect? Very good. Now, when only 25% is business, minus 33AB deduction, your business income is arrived. But let me tell you, but if the coffee is grown, cured, roasted, grounded by mixing chicory or without mixing chicory flavors, then 60% is agricultural, 40% is business. So 40% of the income minus 33AB deduction becomes your taxable income. So like this, we completed the list. We have to understand. Okay, clear to all of you? Very good. Now we completed this section. Easy section for all of you. There should be no doubt in this section. Okay. Now let me come to site restoration fund. Section 33ABA. Here also it is similar. What they say, here you should be engaged in some petroleum business. So if you are engaged in petroleum business like Reliance Petroleum is there, Oil and Natural Gas Corporation is there. For these type of companies, this section applies. Okay. Now, they should also deposit the money. But when within the previous year, here the rule is different. There the rule was within 6 months from the end of previous year or before filing returns, whichever is earlier. There I said like that. But here under 33AB, under 33ABA, Site Restoration Fund, you should deposit the money within the previous year itself. Right? Okay. So you should be engaged in petroleum business. You should deposit the money in within the previous year. You should deposit the money with an account opened in SBI, State Bank of India. That is also the rule here. There it was NABARD. Here it is SBI. Okay. And how much deduction? Here amount deposited or 20% of the profit. Right? Before claiming the deduction under this section or relating to set off and carry forward of losses, before claiming these two deductions, if you earn profit into that 20%, right? 20% of profit or amount deposited, whichever is lower. When you take 20% of profit, the profit should be before 33ABA deductions or before set off and carry forward of losses. And you should deposit the money with SBI. And finally, you should also obtain a certificate from a chartered accountant. Okay. If you satisfy all these conditions, you will get the deduction. So what 33ABA talks about? Site restoration fund. Which business? Petroleum business. Where to deposit the money? In SBI. Right? By what time? In the previous year. What else? Report from CA. How much deduction? Amount deposited or 20% of profit, whichever is lower. That's it. If you satisfy all these conditions, you will be able to enjoy the benefit of deduction. That's it. And other provisions will remain like 33AB only. Right? This way we try to cover entire concept of 33AB and 33ABA in a short video. We'll meet in the next video. Till then, take care. Bye bye everybody.